Hey everybody, thanks for joining us today. Today I have Sara Getchell with Whitecap Mortgage. Sara is my preferred lender. She does an amazing job, and we wanted to talk about some things, some common questions that we get, and some things we really wanted to make people aware of when they're looking to purchase a home and looking for a mortgage. Hi Sara, how are you today?
Hi Marcee, I'm good. How are you?
Good, thanks for joining me.
Anytime, my pleasure.
So Sara, a couple of days ago, we were talking about the 3% trap for buyers. And I was hoping that you could explain that, because that's not something a lot of people know about.
Sure. So the 3% trap, it's sort of new in the news right now as far as what buyers have for their rates, what people that are in a home right now, what they're having trouble leaving their current rate because during COVID, everybody refied down to a 2.75 or a 3%. Yep. And now they're kind of trapped in their home because they feel like they can't go buy another house because the rate is so low on their current home.
I hear it all the time.
Yeah. So the trap part of that, is if you're a seller and you really do want to move on to a different home, you feel like you can. And what's happening right now is a lot of people are racking up their credit card debt and racking up other areas of their life. And so credit cards, home equity lines, car loans, like these are things that have super high interest rates right now.
Extremely high. The highest we've seen since, I think I just saw, since 1994 was the last time credit card rates were that high.
Yeah. And so all of this is going to come to a head. So whether you're paying money for your house or you're paying money for all this other debt, it still has to do with your overall monthly liability, not just your house.
Right.
Right. So in theory, what we can do, and I have tools for this, is to see, okay, if I did sell my house and I'm getting X amount of proceeds from that house, does it make sense to pay off some of my credit card debt, get rid of all that interest that you're paying on credit cards, car payments, home equity lines, whatever it might be, and put less of a down payment on. So you're essentially transferring some of that debt onto your new mortgage and you get a new house. Yeah. So, the theory is once you really compare those numbers, even though you have the higher rate, you're in the house that you want and your overall debt could be lower. So it's just some things that a lot of, people that are moving out of their current home and into the next home don't really think about.
They're so focused on the difference between the rate that they got when they first purchased this home, or for people who were in their house already and refinanced, because we've seen a drop. I think it was like 25% less inventory than this time last year. And last year we were in extremely low. So people really feel paralyzed about selling their home because they just don't want to give up that fantastic rate. Yeah. So I think this is really important information to know.
Yeah, and statistically, we're seeing it already. The unemployment rate is starting to creep up just a little bit, and so people are feeling that tightness and they're starting to take out debt in other areas. So it really is important to make sure you're not just focused on that rate and on that mortgage, but also on what are we looking at all over and what's the big picture there.
Yeah, because a lot of people really are focused on the price of the home as opposed to what their monthly expense is going to be. And I think it's much more important to focus on the monthly expense. Right. That's the important part.
Right. And when you're a seller and you get those proceeds and it's X amount of dollars, part of what we do as a mortgage advisor, that potentially maybe if you're with a big bank or somewhere else may not be having those conversations, is really taking an advisory role to help you. Let's look at your overall financial goals and how can getting those proceeds meet some other areas and aspects of your financial profile.
Right. So in addition to this topic, that kind of brings me around to something else I wanted to talk about today. And that is, where do you start with this process? Because I'm sure if there's any realtors watching this today, or just people in general watching, some people are kind of putting the cart before the horse. Is that right? Yeah. The cart before the horse. They're going out and looking at homes, but they really don't know how much they're approved for. And they're making assumptions based on their salary. But there's so much more that goes into it. Your credit, your debt to income ratio. There's so much to take into consideration. So let's talk a little bit about people who are starting to think about it. When is the right time to talk to a lender? What is the process? How do they get started? Should they talk to a lender before they even speak to a realtor? These are all things I think are important.
Yeah, I mean, today, before I came here, I spoke with a wonderful couple. It was their first time buying a home. And they said, we came to you first. You know, we haven't talked to a real estate agent yet. We wanted to get our financial ducks in a row and make sure that we're comfortable with what those numbers are. And I think that's a great move, because if you do talk to a real estate agent first, which is what happens a lot of the time.
Most of the time.
Yeah. The realtor is going to say, okay, you need to talk to a lender, right? Because the realtor can't really do their job well unless they know what purchase price is, what area, you know, what do the financial picture look like, so I know what homes to send to you and what homes to take you to. So, you know, the first step is to talk to a lender and find out what can we do. A lot of times your comfort level is a different number from what you actually qualify for. Oftentimes you qualify much higher than what your comfort level is. So that's always a question I ask. What is your max comfort level for your monthly payment? And we're looking at easy 3 things: credit, income, and assets. So
what about debt?
Well, that's part of the credit. So the debt is going to be on the credit. And then we add in your house payment in with that. So, so, you know, I always tell everybody too, if anything changes with your income or anything changes with your debts, it's always a good idea. You could be shopping for a home for a week, or you could be shopping for a home for 6 months, and you're living your life during that time, right? So anything could come up, and, you know, that always want to give me a call and make sure that we're staying on the same page as far as that goes, so that you're still on the track to reach your goals. Yeah.
And so about how long does it take for say somebody feels like they're ready to get started, they want to buy a home, and they call you. How long does it take before they're pre-approved or have gone through the process to be pre-approved?
So, I mean, I could do a pre-approval in an hour, or depending on the situation of the person, sometimes it takes a little longer if they're self-employed, if there's variable income, if they're dealing with some kind of debt that needs to be resolved. So it really just is case by case. If they're pretty straightforward as far as being on a base annual salary, and they have the assets for settlement, and they have, you know, decent credit, I could turn it around in an hour.
And Sara, I really want to point out here that I've spoken to people who have said, I am planning to buy a house in the future, but I'm not at a point financially where I can do that yet. I have some debt to pay off. I have some things to do. And I don't care if they're a year out. I always recommend that they talk to a lender now, because they might be making assumptions that are incorrect, and waiting too long or not doing the right things while they're paying things off or doing certain things. So I don't think that there's really, if you know that you're going to buy a house in the future,
there's no downside. There's no downside to getting information and talking to somebody. We can do a soft credit pool, so it doesn't have to hit your credit.
It doesn't hurt your credit.
But knowledge is power, right? So you know, I can run numbers and show somebody numbers for something, and at least then they know, okay, this is what my monthly payment's going to be. Here's how much money I need to work on saving. And I can help advise as far as the credit goes if there's challenges there, you know, and then you're finding out, before you do the wrong thing, you're finding out, okay, what are the right things? What should I pay down or pay off? And, you know, how to get yourself where you want to be.
Another thing that I frequently hear from buyers is that they want to work with a big box brand, or that they've been in touch with them. And I always redirect them to a smaller independent like you. And let's talk a little bit about why that's important. I know from a real estate perspective, being a realtor, sometimes the bigger brand names, banks, that kind of thing, it's really a challenge because they're working 9 to 5. They're not available to the client or myself on evenings or weekends, which are the 2 times that most people have available to go look at houses. And you and I both know that in this market, how many times have I called you? Like last minute, they decided this is the one. We just went and saw it. Can you write their pre-approval? And it's so important not just to have, you know, a kind of a, I don't know, like a general pre-approval. It really needs to be specific to the house. It makes them stand out in the process more. So that's one of the things. So tell me the reasons why you think that it's better to work with a smaller independent lender.
So even just talking with agents that, that is something that I always hear is the availability. Also, the big bank lenders, typically the process is a little clunkier from what I hear as far as like going through the hoops that need to be gone through to get through the process. Look, the mortgage process is stressful. We try to make it as low stress as it can be, but there's documents, there's timelines, there's things that need to be met. And sometimes it's hard, when it's hard to get a hold of someone, or it's taking forever to get, any communication from anybody, you can't get a hold of anybody. That's one of the challenges with the big box. Also, just, I've gotten estimates as a second opinion, or, from seeing what someone has gotten from another bank. And a lot of times there are missing fees in there. There's missing home insurance. They're only collecting 6 months of taxes when they should be collecting 12 months of taxes. And typically what happens in those situations is the buyer gets to the end of the line, and then the bank says, okay, you need $2,000 or $3,000 more dollars, right?
Yeah.
And meanwhile, in the beginning, the bank, pulls in that buyer because their cash to close looks lower potentially than what my cash to close looks like.
Right.
When typically, my cash to close is about $1,000 to $2,000 lower on settlement day than what I'm showing them in the estimates, because I never want to call somebody and tell them you need more money. I always want to call them and tell them you need less money than what I told you.
Yeah, exactly.
So, that's a big piece of it. And I also feel with, being a broker and independent, I have access to so many more products and so many more. I have the opportunity to call a lender and say, hey, do you have this product available? Okay, sign me up. Let me get that. Right,
and that's the bigger piece, is that you have so much at your disposal. So that makes a huge difference. Whereas, a bank might only have a couple of options within the bank that they can offer.
Right.
So here's something. I met with clients recently, last week, who want to buy first and then sell their house, but they need the money from their house to buy the next house. But they're in a good spot because their mortgage is 100% paid off on their current house. So I was talking to them a little bit about a bridge loan. So let's talk about that and why that's really advantageous, especially in situations where people have their house already paid off.
Yeah. So the bridge loan is fabulous. We have a few lenders that offer the bridge loan. Basically, you're doing 2 loans at the same time. You're doing the loan on your new home that you're buying, and you're doing the loan for, it's basically a home equity line of credit. It's very similar that the bridge loan is. It's an adjustable rate that you have for a short period of time. So you're doing both of those at the same time. The notary comes to your house to sign off on the bridge loan. You get those funds, however much it's deemed that you're able to get, and you bring those right to settlement. They go right to the settlement costs. So it's a way for you to use that equity at the same time without having to go through the separate home equity line of credit process, which with banks can take a while, can take 45 days, 60 days.
Yep.
So you're doing it simultaneously through one lender.
Now, what if they don't want to get a mortgage on their next house? What if they want to pay cash? Can they still use the bridge loan, like use that as cash to buy the next house?
No, they'd have to get the first mortgage and then the bridge loan. If they don't want to get a mortgage at all, I would probably recommend knowing that as early as possible and getting some type of a home equity line of credit so that you can pull from those funds and then just pay for the new house in cash.
Okay, so you would recommend a home equity line of credit over a bridge loan for people who want to buy a house first with cash if they're not getting a mortgage for their second home.
Correct.
Okay, that's good to know. And I'll go back to my clients and
then with the bridge
talk
loan,
about that.
you may not even ever have to make a payment on that bridge loan because you're going to sell your house.
Right,
and then you pay it
back.
off right before probably you're even going to make a payment on it.
Yeah.
So it's a great thing for sure.
Yeah, okay. And then one of the things that you and I talked about that we've been seeing in the market is appraisal shortfalls recently. Let's talk about that a little bit.
Okay. So, a lot of times buyers right now are covering an appraisal gap, right? Yes. So what does that mean? Can you explain? I mean, I know what it means.
I know you do. So when people are buying a house and in a super competitive market like we're still in, there's been multiple offers and people are not only offering the seller what they're asking for the house, but they're offering over that. And then the seller is hoping that the offers will include what we call an appraisal gap, which is the difference between what the home appraises for and what you've offered on it. So let's say a house is $500,000 and you've offered $575,000, but the comps in the neighborhood really only bring it to $525,000. Well, the buyer might be saying, we are going to pay the difference between whatever the appraisal is at, say it's $525,000 and what we've offered at $575,000. So we're going to bring that $50,000 in cash to the settlement table to make up the difference.
Okay. Yep.
Yeah.
So what I do and where I kind of come in when that happens, like let's say the appraisal comes in low, I will provide new estimates for my buyer with options, right?
Okay.
Here's your option if you want to bring that full $50,000 to the table in cash, okay? Depending on how much money you're putting down on the home, you may not have to bring any more money to the table in cash. So for example, if you have 20% equity in the home or you're putting a 20% down payment and your house under appraises, we can change the loan to value. So when you're putting 20% down, your loan to value number is 80%. Right? So we can change your loan to value potentially to an 85% or an 87% or whatever that percentage needs to be so that you don't have to bring any more money to the table. Exactly. Now, what's the downside of that? It's mortgage insurance.
Right.
So, especially if you have someone with pretty good credit though, if you're going from an 80 to an 85 or an 87, we're talking about maybe $60 a month in mortgage insurance to be able to not have to bring maybe another $50,000 in cash.
Right.
So it's weighing those options. Is it worth it to me to pay another $60 a month, still move forward with this house and not have to come out of pocket with that 50 grand, which potentially you could save or use or put in an account that's going to make money for you as opposed to just throwing it into your mortgage.
Yeah.
So these are all the conversations.
And this is why it's so important to have a team around you when you're buying a house and getting started on this early, not jumping into it when you find the house you want. Because sometimes you and I might need to spend a little bit of time. Like I've looked at a house with a buyer. I know that there's probably an issue with the appraisal gap. It's probably not going to appraise for what they're offering. But to get the house, they have to be able to offer that. So you and I can get creative and talk about what the parameters are. And so the buyer doesn't have any surprises then. They really are informed buyers and they know in the end how much they could potentially have to really stretch to get the house and what's feasible for them.
Yeah.
It's not black and white. There's a lot of gray in between.
Yeah, and I have definitely done estimates before someone even makes an offer on the house, if that's the concern. Okay, what if it underappraises by X amount? What if it underappraises by X amount? And I can show them that side by side and the different options with the loan to value.
Right.
So that they go into that offer with confidence and knowing, okay, if this is worst case scenario, I'm prepared for that. I'm ready for that worst case scenario. And then they're pleasantly surprised, hopefully, if it's not that.
That's always best case scenario.
Right.
So let's talk about private mortgage insurance since we brought that up. So why don't you explain what private mortgage insurance is?
Sure. So when the Dodd-Frank Act came out for mortgages when the crash was happening, the government put in place private mortgage insurance, which is anytime you have less than 20% down, you're subject to paying mortgage insurance.
Right.
The mortgage insurance with a conventional loan is tiered based on your credit score and how much you're putting down. So there's like a chart that we look at. So if you have an 800 credit score and you're putting 15% down, you're going to pay less in mortgage insurance than you would if you have a 600 credit score and you're putting 3% down.
Right.
And so there are options as well for doing, paying a one-time fee up front to not have the monthly mortgage insurance.
Okay. That's probably more expensive.
It is. So right around, and you can't do that until you have 10% down. So once you are putting 10% down, we can start showing you those options for, it's called a single premium mortgage insurance, where you pay it up front and then you don't have the monthly. What I have found is most of the time you're paying less money just doing the monthly mortgage insurance and getting rid of it when you can versus paying that giant fee not to have it.
Yeah. And when can people get rid of the PMI?
Yep. So once you have 20% equity in your home, that is when you can get rid of the mortgage insurance, but it's not going to automatically drop off. So It does drop off once you reach 22% equity in the house.
Okay.
But if you want to get rid of it and not pay that extra money to the mortgage insurance,
Right.
then when you think you have the 20% equity is when you want to call and apply to have that dropped. And usually it's a couple $100 fee to do that. They may or may not ask you for another appraisal, but if so, it's typically maybe couple $100 for that as well.
So they just call the mortgage company that they have the mortgage with.
Yep.
And ask for that.
Yep. I want to apply to have my mortgage insurance dropped. Yep.
Okay. And how many times can you apply? I mean, obviously you don't want to apply very many times because usually there's a fee, but let's say you applied in February of this year and now you really feel and you couldn't get rid of it, but now you feel really confident that you've got the 20%. Can you go ahead and do it now?
Yeah, I mean, I'm not sure. It would have to do with whoever's servicing the loan and what their policies are on that.
Okay.
But I have never heard of there being a cap as far as how many times you can apply to have the mortgage insurance dropped.
Okay. Okay.
Yep.
All right. Or a certain time frame. Like
Right.
if you do it, you have to wait 2 years to do it.
Sometimes there is a policy, they like to wait 2 years, or if it's not been 2 years, they want to see what kind of renovations have you done over these 2 years that that show that you do have that equity. So it just kind of depends on who the servicing, entity is for the loan.
Okay. Okay. And will they accept an appraisal? Let's say somebody is thinking about doing it and they want to have an independent appraisal. So they hire an appraiser to come in and do it. Will they accept that as the appraisal?
Typically not, because the reason why
it has to be regulated.
Yes. And because the house, if with the person who's doing the loan, the house is the collateral, right? And so the lender wants to have that assurance through their appraisal or whatever company that they're set up with, that what they're getting is accurate, and they want to have that documentation to stand behind.
Yeah, and it might still be beneficial to have an appraisal done, just so that you know if you're there.
Yeah,
and yeah. I think so anyway.
Yeah.
Well, thank you, Sara, so much for being with us today.
You're welcome.
And for sharing all your knowledge. And everybody, like and subscribe, but also follow along and let us know if there's anything that we didn't cover today that you're really interested in, because this is not the last time we'll have Sara as a guest speaker. So thanks everybody.
Oh, thank you. Thanks, Marcee.
Thanks.
Ask Sara how people can get in touch with her and find her too.
Sara, Sara, how can people reach out to you directly if they have questions about the lending process or they want to get started?
Sure. So they can definitely call me. My phone number is 610-656-5098. I have an email. It's really simple, Sara, S-A-R-A, @whitecapmortgage.com. I do also have, we have a website, whitecapmortgage.com. So definitely reach out. Oh, definitely social media. Yes. Of course, also social media. I have a Facebook page. I have an Instagram, Mortgage Getchell Sara, I think.
Yep, it is.
So, yeah. You can find me.
Yep.
If you want a mortgage, you can find me.
You can always reach out to me and I can put you in touch with her too.